Right, well, we might get going. Good morning, everyone. I'm Michael Sardi. I'm the executive responsible for Business Bank Metro across Australia. I just wanted to say welcome and thank you for attending the webinar, where this morning we'll be discussing the insights and opportunities for a very important segment of our economy, and that's the wholesale and trading business sector. Before we begin today, I would like to acknowledge the traditional owners of the country on which we meet today. I'd like to acknowledge the Wurundjeri people of the Kulin Nation as the traditional custodians of the land on which I currently am sitting. I'd like to acknowledge all elders, past and present, as well as the future leaders who continue their role as proud custodians of the country they belong to. I'd also like to acknowledge all of our Indigenous customers and colleagues who join us today on this webinar. Today, I'm joined by a group of panellists and presenters, and NAB Group Chief Economist Alan Oster will share with us his market insights. The NAB's Head of Economics, Dean Pearson, who will shortly talk to us about supply chain issues. And then we've also joined by NAB Executive Trade and Working Capital, Jackie Cooper, who's dialing in from Wagga, and NAB State Director of Business Markets, New South Wales, Tracy Ferguson, who will join us for panel and Q&A a little bit later on. Well, the topic of supply chains has quickly moved from a subject discussed in the boardroom to something now discussed around most people's kitchen table, as it's actually impacting everyone on a daily basis. We're now more aware as to how fragile supply chains can be in the face of natural disasters, health crises, or international incidents. The sector of wholesale and trade businesses is absolutely critically important to this Australian economy. And as Australia's largest business lender, we're here to clearly support wholesale and trading businesses to grow and achieve their goals. We believe that continued investment in local manufacturing facilities, together with strong transport infrastructure and a stronger labour market, is critical to improving our future resilience. Look, some statistics that might put this into perspective are as follows. Like our business bankers who specialise in supporting manufacturing and manufacturers have lent more than $7.5 billion to the industry to enable domestic production of everything from fencing to coffee beans. We've also made sure that businesses who need to place forward orders can secure stocks, and have been able to, with more than $6.6 billion in working capital lent over the last 12 months, just to keep Australia moving. This is an increase of 36% on the previous 12 months. In the 12 months to 31st of March, we've also increased our lending to this sector by 22%, and that's an amount of $13.5 billion. And we've seen an increase in the number of wholesale trade customers by 12%. So today we're really pleased to be able to share our expert insights with you, and hope that you find these absolutely useful in terms of your thinking about the future, some opportunities that you might identify through this conversation that you could then apply in your businesses. So in today's session, our experts will be discussing supply chain insights, impacts and strategies for all of us. And so what we might do now is just hand over to Dean Pearson to give us his insights as to what he's seeing about in supply chain issues. So welcome, Dean.
Thank you, Michael, and good morning, everybody. Well, from the behavioural economics perspective, human behaviour really has been at the core of the COVID crisis. As the pandemic unfolded, we've seen behavioural change really become the goal for governments across the world. And despite some challenges, we've noted that public support has generally been quite high for prevention behaviours. But at the same time, we've also seen some less community-minded behaviours, including hoarding of protective equipment, hand sanitizer, groceries, and of course, toilet paper. Suddenly, supply chains became a matter of national concern. Now, most consumers in wealthy economies rarely think about such things, but now they're faced with shortages of really some very basic items. And we faced with similar circumstances again, many people would behave in exactly the same way. to try and get back a sense of control. We have a very basic fear of missing out as human beings, and we are also prone to the so-called bandwagon effect, where we blindly follow the actions of others. But irrational behaviour like hoarding is not abnormal behaviour. When people feel threatened, they show some predictable behavioural responses. They feel more conservative, they become more risk averse and more insular. Consumers really are central to a post-COVID economic recovery, with household consumption making up about 60% of GDP. Now, no other event in our lifetimes have changed so many consumer behaviours as abruptly and as drastically as COVID. Now, with lockdowns imposed in many parts of the country, people retreated to their homes and they pivoted their spending towards goods rather than services, which placed further pressure on supply. Even before COVID, bricks and mortar retailers were facing certainly growing competition from more established digital retailers, but those challenges accelerated overnight. Consumer expenditure, and increasingly in regards to direct consumer ordering and rapid fulfillment of orders, has become much more important. But such disruptions in daily experiences present a really rare moment. Consumers will tend to stick stubbornly to their habits, even really beneficial ones that require behavioural change. So this has become a really unique moment in history for businesses to shape unprecedented shifts to position products, services and brands going forward. Many businesses are using these changes in consumption behaviour and market dynamics as a once-in-a-generation opportunity to consider bold shifts in their channel strategy. Now, of course, the wholesale distribution industry is also rapidly evolving, with suppliers and retailers looking to slash cost and time to market, and the growing power of huge marketplaces such as Amazon. Some predicted that retailers and suppliers would sever their relationship with wholesalers. However, wholesale distributors resisted this trend. They reduced their costs to meet a wider range of customer needs, using customer data to anticipate and shape those trends. Distributors still have a vital role in supply chains, and there are unprecedented opportunities for growth. Wholesale distributors must continue to combat direct deliveries with faster delivery times, easier returns, and cheaper logistics. One of the most powerful tools that distributors have at their disposal, and Alan will talk about this in a moment, is access to huge amounts of data on everything from supply chain operations to consumer behaviour. So moving to the first slide, please. The challenge of supply chain disruptions are clearly huge. As you can see here, 3 in 10 Australian SMEs say supply chains are currently a very significant issue for their business. That's climbed to 35% of businesses in Western Australia. By industry, not surprisingly, concern is greatest in your sector. 1 in 2 SMEs in wholesale are very concerned, but it's also highly problematic, as you can see here, for a large number of manufacturers, retailers, and those in the construction sector. Also of concern, in the second chart there, you can see looking forward, 1 in 4 SMEs still expect supply chain to be a very significant issue for them 12 months from now. But moving ahead onto the next slide, please, we also asked SMEs, well, what strategies are their business currently implementing to try and help overcome supply chain issues? And the top response you can see in the first chart there is the right one, which is managing customer expectations. Keeping customers in the loop, setting expectations for delays is absolutely essential, and being realistic about those delays. Expectations going forward, there's a need to provide a time frame upfront. Promising delivery only to repeatedly push it back clearly will not work. The other thing that doesn't work is empty shelves. Sends completely the wrong signal, and stores can reconfigure, and we're seeing that, product displays to showcase those items that are currently available. Online retailers are showcasing the items in stock at the moment. Now, the second response you can see is diversifying the supply chain. Second top response, sourcing multiple suppliers. And many businesses we know will have to work with perhaps 2 or maybe 3 or even more suppliers and evaluate them regularly. If a product is produced overseas, can a business add an option closer to home? If they depend on a single component, is there a backup? Total costs are becoming really important, particularly given transportation costs are on the rise. And of course, we know finding a new supplier can be difficult. One more extreme option, of course, is to talk to competitors, to form a partnership to try and find a supplier. 3 in 10 SMEs were looking to or had already increased prices. A similar number were holding back more stock or raw materials. Other strategies, as you can see there, were sourcing local suppliers, new distribution providers or channels, and improving demand forecasting or scheduling ability. Now, clearly the right inventory management, or the earlier a business can predict a shock, then the faster they can react. And that can make it much easier for small businesses. For a long time, the pressure has also been on supply chains to be as lean as possible. During COVID, those who relied on just-in-time inventory models a business were much less able to take advantage of those spikes we saw in demand. Educating customers on alternative products can also build loyalty, with some might need to help customers find a product, even if it is from a competitor, to gain goodwill going forward. Something simple, as I said before, as stock notifications can give a business an edge to get a product in front of a customer as soon as it's available. For many SMEs, this disruption in the longer run will place them in a much stronger position and a more resilient position. And most businesses now have a much greater visibility of all aspects of the supply chain. Now, unemployment, we found recently, fell to 3.9% in April, so it's its lowest rate since 1974. But the scale of those shortages remained, we thought, quite poorly defined. So moving on to the next slide, please, we can see where NAB recently surveyed 1,600 Australian businesses across a broad range of industries and sizes who shared their view on how prevalent that issue is today. What you can see here again is WA tops the country with the highest number of businesses. 44% of businesses said labour shortages were having a very significant impact on their business. WA also leads going forward to the next 12 months. 43% still think it will be a big concern. By industry, not surprisingly, construction is under the most strain. 1 in 2 businesses telling us that labour shortages are having a very significant impact on them. And as you can see in the second chart there, trade workers, professionals were the most common type of labour shortages, but also sales workers, labourers, general unskilled labour, and machinery operators and drivers. We're also keen to ask business what they saw as the solution. So in this next slide, you can see the very clear message that they sent us. Just wait for the next, thank you. Over 1 in 2 businesses said that they must open state and international borders, but keep them open. But they also identified a number of other areas, things such as traineeship and apprenticeship, more migrant intake, more work-life balance. Money is important, but you can see here, fairly far down the list there is higher pay for staff. Increasing salaries is certainly one factor, but there are many others, things such as culture, purpose, diversity, strategy, and developmental pathways. Ensuring existing staff have a career prospect and are developing new skills through training and development is becoming really important. Organisations in particular some sectors need to do a little bit more to make a job more attractive, particularly in sectors associated with perhaps heavy physical labour, long hours, and potentially dangerous work practices. And we are seeing shifts in sectors such as hospitality, who are realising that more fundamental changes have to occur to attract labour in that segment. Now, with the borders reopened and international students and workers being able to apply for visas, that is certainly a solution, but there is a huge backlog, which is putting further delays on an already very lengthy approval process to get into this country. A lot of people assume that you can simply flick a switch on migration and everything comes back to normal. It just doesn't happen that quickly. We also know that while foreign students are a really important way of filling gaps, and backpackers in particular for certain types of labour, what hasn't really happened yet is a really clear long-term developmental pathway for a person to develop residency and citizenship. Now, what about the so-called Great Resignation? Now, the Great Resignation basically predicts that people will voluntarily leave their job in record numbers just as the pandemic encourages a rethink of careers, work-life balance, and long-term goals. Now, moving to the next slide, please. In some countries, we know, notably the United States and the UK, there was clear evidence quite a while back that this was occurring. There were many commentators in Australia that said, well, this probably won't happen here. We think it certainly is happening and will continue to happen. We researched a number of Australians and we asked them, after decades of very low employee turnover, what their expectations were moving going forward. And you can see in the first chart there, just over 1 in 5 Australians told us these are Australians over the age of 18, had changed their job within the last year. 1 in 4 were considering leaving their current place of employment. Over 1 in 3 identified COVID as one of the prime reasons. By employment type, turnover expected to be greatest amongst machinery operators. By industry, it's sectors such as telcos, agribusiness, and construction, which are expected to see the biggest churn. Increasingly, we're also seeing some evidence of the so-called boomerang effect, where people leave a job only to return to an old workplace after a little period of time. But the workforce clearly has more than ever more leverage, more choice, and more opportunities. So in the next slide, we also wanted to understand why Australians were really considering moving on to jobs. Now, there are two reasons why people will move. One is a push factor, things that really encourage them to leave a job. The other things are considered to be more pull factors, things that attract people to a new job. Looking at that chart, you can see these are very clearly push factors, things like lack of personal fulfillment, lack of purpose and meaning, poor pay, mental health, poor work-life balance, burnout, and feeling like a fresh start. Poor employee experience is to blame for much of today's attrition, particularly amongst people leaving a job without another job to go to. So put simply, employees and businesses more generally have to work harder at empowering frontline workers to exercise judgment. Things like poor health and well-being, we know, are a big driver here. The strength of a relationship with an employee's manager and people leader is one of the strongest predictors you will find of job satisfaction. Organisations are clearly investing in that. Now, rates of resignation were highest amongst younger workers early on in the Great Resignation. That truly happened, certainly in the United States, and it's been happening here. But what we are seeing in the US more recently is quit rates are starting to rise for older people as well, who have worked at a job longer, who have the financial means to wait longer before they take on another job. So some people are calling that the great midlife crisis. I'm in that age group. I'm not sure I'm having a midlife crisis. But I actually don't think the Great Resignation is the right word, because many workers are not just simply quitting, they're seeking change. And that change has been enabled by COVID and technology and labour shortages all converging. Now, the other thing that's radically changed, we can see in the next slide, is people working from home. Now, of course, until 2020, many of us went to our workplaces even when there was an option from working from home. Now, when we survey time, we do time surveys of people, and currently, on average, Australians tell us that they're spending around 59% of their work week at the workplace, 41% at home. Most particularly professional managerial workers, office workers, but aspirationally, all workers are saying that they would like to shift to some sort of hybrid working. Now, some businesses, particularly businesses such as Google, who were long staunch opponents to working from home, shifted towards a working from home model. In early April, they allowed people to come back to the office, but only for 3 days a week. Now, some businesses are pushing back. There's reports today that Elon Musk has sent an email to all of his staff at Tesla, telling them that they must work a minimum of 40 hours a week back in the office. And if they don't turn up for work at the office, he is assuming they are resigning. I've got to say, even before the pandemic, there was a whole range of evidence that shows that there wasn't necessarily a big productivity penalty from people not working from home. In fact, you can see when you ask people in that first chart, what is the biggest benefit of working from home? They say that it's productivity, that they say they have the capacity to get more work done. I'm not sure they're working harder, but I do think it has created a flexibility for people to work on their terms and the hours they want. Now, as I mentioned before, the consumer is really critical to a post-COVID recovery. And in the next chart, we're talking about consumer confidence. Now, consumer confidence is an important driver of demand in our economy, but there are a number of consumer confidence measures in Australia, and I'll just let the next slide come up. Thank you. Now, the best we can say about consumer confidence, even though it gets reported every month as if it's telling us exactly what's happening to spending, is it tells us basically what happened perhaps 3 to 6 months ago. NAB's measure of consumer sentiment is based on typical household stresses, things like job security, health, our ability to fund retirement, cost of living, and government policy. We think it's a more timely indicator of what's hurting consumers right now. And you can see that after a long period of decline, it's ticking up. And in the chart in the top right-hand corner, you can see it's certainly not job security, which is that white line trending down, but it is the green line, cost of living pressures. Now, a question that often doesn't get asked by business is, when a business adjusts a price, does the consumer even notice? And often they don't. This time around, if you can look at the chart in the bottom right there, they are certainly noticing. Up until recently, they did notice certainly about groceries, utilities, and transport costs, which are the three they will always notice. But more recently, you can see those bars are trending up across the board. In effect, consumers now believe, and in many instances they're right, that prices are rising across the board. The other thing that's rising, of course, and Alan will talk about in a moment, I'm sure, is interest rates. And moving to the next slide, please. The expectation is they will continue to rise, and that will flow through into a number of channels, particularly into impacts on household cash flow and mortgage servicing costs. When we ask Australian homeowners, how do they feel about the prospect of rate rises? On average, the average person says, well, I'm not too concerned about it. However, as you can see there, 29% of Australians expressing a very high level of concern about rate hikes. Now, That, of course, will flow through to the property market. The next slide shows you another reason why we're pretty sure that residential prices aren't growing anytime soon, and that is the number of Australians who think now is a good time to buy a home. It fell for the fourth consecutive quarter. It's now down to 23%. It was up to nearly 50% at some point there. The opportunities to buy an investment property, only about 24% of Australians think it's a good time to buy an investment property. And those numbers certainly aren't upticking in the next 12 months. The thing that still is holding, I've got to say, a bit more strongly, if we go to the next slide, please, which is impacting upon you in terms of supply chain impacts, is renovations. Around 13% of Australians were currently renovating a property as of Q1 2022. Around 1 in 3 Australians still believe now is a good time to renovate, despite the fact that we've seen big rises in material prices. Over 1 in 2 note that it has become more expensive, but we are still seeing that 1 in 3 continuing to say it's a good time to renovate. Now, normally, the sorts of price rises that we have seen in the past 2 years in many materials would have taken many, many more years than that to roll through. We also know that with travel plans off the cards, many people have turned towards their home and reinvested in their home as a result of that. That's pushed more pressure on supply and demand in the construction sector. Since the pandemic, we know the cost of timber has risen in the order of 250%. We've seen steel at a 10-year high. And some of those shortages, of course, have been attributed to the 2019-20 bushfires, where tens of thousands of hectares of softwood plantation were impacted. One of the things we also conduct is a residential and commercial property survey. And just showing you here, the next slide, please. These are the latest response we get from our commercial property survey, which is undertaken by around 400 real estate agents, property developers, and property investors. And that really growth in demand for warehousing as clients move from a just-in-time to a just-in-case position is very clear in the results. The overall index kicked up. It's a measure of rents, capital values, and vacancies. It's positive now. It's gone up for the first time in 2 years into positive territory, you can see, but largely driven, of course, by the industrial sector. And despite low levels of population growth, despite inflation and rising interest rates, expectations in the property market are that we will still see demand for warehousing continue to rise, with some of the forward-looking indicators also more optimistic. You can see expectations around national industrial vacancies were up a little bit. They're around 4%, but very low in New South Wales, 2.8%, and Victoria, 3.4%. So as a result of that, the outlook for industrial rents is also more positive. We know that warehouse capacity constraints have seen many retailers being unable to capitalise on that surge in online sales at the peak of the pandemic. In Australia, we saw strong demand at the moment for really big spaces, 50 to 100,000 square metres, space that we normally don't see big demand for. Many companies are now looking at more complicated facilities, far more bespoke buildings. They're asking themselves increasingly a number of questions around whether the accommodation space they have in their warehouse will suit their future needs, whether they will suit sustainability initiatives going forward, whether they are capable of being retrofitted for automation, and so forth. Now, the consumer is also driving many of these issues as well. As relaxations relaxed, many consumer and marketing experts basically predicted that many people would go on revenge spending shopping sprees. And we knew certainly that higher income households have the money to splash out. We know households have banked a lot of money in savings over the pandemic. If we move to the next slide, please, though, I'm not so sure whether people are going to splash out going forward. When we ask people, what are you going to spend on? What are the big things you're going to spend on going forward in the next 12 months? What you can see here is there are 2 categories. One, to some extent, is the green line, which is in property, but the big one is travel and holidays. Expectations were either flat or weaker for all other types of spending categories, especially things such as school fees. Now, one of the big drivers, of course, that is shifting spend is the next slide, please, which is online retail. And the rapid evolution of digital is clearly set to continue. We note from our trend data that in the 12 months to April, Australians spent around $57 billion on online retail. That represents about 15% of total retail trade. That's still up 19.6% on the 12 months to April 2021. We know the fundamental purpose and role of retail stores is changing, but physical retail is still the largest and the most important channel, of course, for the foreseeable future. But how that space is being leveraged is transforming. We know the pandemic has seen a long overdue reset, which will move many retailers to a more stable position going forward. Traditional bricks and mortar metrics, things such as gross margin per square metre, are becoming much less important in an omni-channel environment. Speed and convenience are increasingly defining a positive shopping experience as consumers become a lot less patient. One-day delivery is set to become increasingly the norm. But that retail experience is still inherently physical. Consumers still often need to touch products, and that sensory stimulation of visiting a store can't be easily replicated online. Physical stores can act as showrooms where consumers can get to know a product. They can also act as distribution hubs. And importantly, consumers often spend more in a physical environment than they do in an online environment. But consumers are also, we know, likely to continue to gravitate towards digital tools that will make it easier for them to save time. And in the next chart, you can just show how important that transition is becoming towards comfort levels around a digital shopping experience. So I'll just wait for the next slide. Thank you. We asked Australians about their preferences. We said, do you want to preference exclusively online, a mix of both, or do you not care at all? And when you do that, you can see some really interesting results. In banking, for example, we can see 1 in 2 Australians preference purely digital interactions. A further 3 in 10 didn't care. Similar sort of numbers you can see in holidays and travel. 1 in 3 Australians said they strongly preferred to purchase their holidays online. We also saw a reasonably strong uptick for things such as watching movies, further education, buying books, and viewing a sporting event. In retail, you can see the strongest preference shift is towards books. 23% strongly preferred online, 43% were happy with an even mix. Now, in addition to monitoring consumer stress, we also explore how consumers' emotions, attitudes, and preferences are changing as well. We track around 40 key behaviours each quarter. And if we move to the next slide, please, what we're seeing is many habits that were formed during the crisis are very much likely to endure well beyond it. Consumers are becoming more informed, more demanding, and more impatient for fast and more efficient service. The expectations of ultra-convenient one-click checkouts and that they're experiencing on sites such as Amazon is being replicated across many others. Now, demand is growing for that same-day delivery and instant delivery, but of course, there is a little bit of tension there, and I'll show you in a moment, pressures around sustainability, for example, with that one-day delivery. As you can see here, the biggest positive change that we're reporting is support for local businesses. Also support for purchasing Australian-made. We know that consumers are being mindful how they're spending their money, but the behaviours around cooking at home, time spent on screens, all of these sort of things are translating into differences in how people are purchasing and how they're interacting in their purchases. What you can also see if you go to the complete other end of the scale is consumers are still, while it's recovering, consumers are still saying, I'm not holidaying as much, I'm not dining in as restaurants as much, I'm not going to gyms or major shopping centres. When we ask Australians the extent to which they are avoiding people and places due to COVID, almost 3 in 10 are still actively avoiding public spaces, even though they are open. So I would say, to summarise all of that, that now more than ever, businesses are recognising the true value of wholesalers. Most are looking for distributors that can provide smarter and safer fulfilment options, but understanding that customer is absolutely paramount. So thank you. I would now like to pass on to Alan, who will take us through some of the macroeconomic drivers that underpin how businesses and consumers are behaving. And just a reminder that if you would like to read more about our supply chain research, I've been told that it's up on our business research and insights page as of this morning. Thank you. Thanks, Alan.
Thanks, Dean. Unlike Dean, I'm not going to use slides. We've only got 20 minutes, so I thought I'd just talk to you. And if you want, we've also got a pack that you can go through at your leisure. So let's start off. I'm just going to signal a few things that I'm a bit concerned about the global economy. I think basically there are 3 areas of concern. Area number 1 is China with the lockdown that they've got. Their vaccine doesn't really work that well against Omicron, so they lock everything down, and that has some pretty bad impacts, not just on the economy, but also on supply chains. So you see out of Shanghai, containers are down around about 30% in April. I'm sure they're down even more in May. So that's a short-term problem. The next one is Europe, where obviously we're worried about Russia, Ukraine, And in particular, you may have seen yesterday that essentially Europe banned oil purchases from Russia outside of pipelines. And that's the outside of pipeline is mainly Hungary. And so they had to get Hungary across the board. The big issue there is, what will Russia do in response? And I worry that what they'll do is they'll say, probably as the Europeans go into winter, you can't have any of our gas. And I think that will cause a lot of disruption. And then finally, the third area that I'm a bit worried about is essentially the US, where you've got quite an aggressive central bank. They're going to go 50 basis points in June and July. Maybe they might sit back and wait and look in September. I hope so. But if you basically go really quickly on monetary policy, you do need to worry, because monetary policy normally takes 12 to 18 months to come through. So to some extent, they're flying blind. If you then add together those sort of increases in rates and you put high commodity prices, basically the models we traditionally run essentially say that by the second half of next year, the US economy stalls, or very little growth. And so we see slowdowns in the global economy, both this year and next year in particular, and it also shows up a lot in 24, particularly if the slowdowns at the back end of next year. So the global outlook, I think, is concerning. Now, I'll turn then quickly to Australia, and there I'm less concerned in the short run. Now, you would have seen yesterday the national accounts, which were quite strong. I think one of the features of the accounts, however, were, again, supply chain related. There was a massive increase in inventories. So what happened was everybody tried to get their supply chains fixed up. And so you had this massive surge in imports that essentially are still sitting in stocks. And that actually added more than the entire growth rate of the economy. So what we saw in the accounts was reasonable consumer growth, particularly given Omicron and floods. We saw pretty flat business investment and very strong public sector demand. Now, rather than telling you what I think will happen in future, I'll update you a little bit, as Dean was talking about, our data, because that's the big change that we've seen through the virus, the vaccine, and that sort of area. What we now can do is we look each Wednesday on what happened across our systems of last Saturday. So the pack that eventually you'll see will have data up to the 24th of, the 28th of May. So it's almost real time. 3 areas of the data. Number one, transaction accounts. So everything, credit cards, BPay, direct debit, etc., etc. And what we've seen there is a very weak January, and then an acceleration in transaction spending, particularly in hospitality. And that is still going at the end of May, although it is starting to slow a bit. So if you sort of look at that data, you would say consumption is going to be quite strong in the June quarter. We are seeing signs of it slowing a bit, and it may be the case that you can't keep the momentum going strongly, and we'll watch that. The second area that we look at is the revenue of business bank clients, which we see. And basically, we're trying to track it against what happened in 2019. Of course, if you use last year or the year before, you get all sorts of weekly ups and downs, and it also moves around according to Chinese New Year or Easter time and things like that. But fundamentally, what we're now seeing is quite strong growth in revenue. Obviously, mining is shooting the lights out because of high commodity prices. But unlike last year, where it was mining and agri, this year it's much more broad-based. This year it's including areas like transport, wholesale. We're seeing anything to do with manufacturing is very strong. Construction, in our data anyway, and it surprises me a bit, is still okay. Retailers sort of in the middle of the pack, and we're still having difficulty in areas such as health, where elective surgery and shortage of nurses and doctors, etc., are still causing grief. But I suppose the other thing that's really interesting, and again, we don't normally publish it, but it does give us some really some really interesting insights. And that is, we can watch where the consumer's getting money and spending money. And therefore, we can see consumers who are NAB customers being paid the dole. So we can basically see essentially an unemployment equivalent as of last week. And the message you get out of that is that in May, the data was stronger than what it was in April. So we would expect to see unemployment coming down. So if I think about what we're expecting for growth, we basically had a bit stronger growth than we were expecting in the first quarter, maybe a bit weaker growth than we'd previously expected, because we were having a very big bounce back in June. Maybe now it's only 1%. But generally what I'm saying is that we're seeing the economy increase during the course of the year. So that's December on December by around 3 to 3.5%, which means your average growth in the economy is around 4. So this is very different to what you're seeing offshore. Where we see the slowdown coming is the global economy slows and we see rate rises. And so that takes our growth rate momentum from 4% this year to something like 2% in the next 2 years. Now, obviously, we're talking a lot about supply chain issues, and everything in our surveys and our internal data talks to purchase costs still extremely high, in fact, continuing to go up. And if we look at the data that we had for April, and we'll have May data in the next 2 weeks, it was growing at 5% per quarter, so 20%. In some areas like construction, wholesale, it was even higher than that. And that is now showing up increasingly in areas of goods inflation and particularly retail inflation. And on retail, the national accounts also are showing strong increases in essentially what we call deflators or price indicators in the March quarter. And we see the core inflation rates that are currently around 3.5 to 3 3/4 going up to something like 4.5, maybe 4 3/4. And they don't really come down much over the course of the next 6 months. We sort of still have a 4 in front of our inflation numbers by the end of the year, and maybe 3-ish in 23, and only maybe down to about 2.8 in 24. So the inflation story is still very there. It's really important. The wages data is still not great, as in it's not that high. The official data is like 2.5. You can use some of the national accounts data and it's still got a 3 in front of it. So it's not great. Unit labour costs are not going up that much. So you still get this cost of living problem, and that is a big issue for most consumers. I know that a lot of people say saving rates are really high. Well, yes, except most of those savings are held at the top 15% of the income distribution. What we're seeing when we look at consumers' money coming in versus money going out, it's about flat. So they're spending everything they've got, and that's why they're worried. They can see inflation going higher, and they can see their wages not keeping up with it. Now, eventually, with unemployment at around 3.5%, which is what we expected to see, that will generate some more increases in wages. The national wage case comes out at the end of June, and presumably it's got a 3 in front of it for national wage cases, which will flow through to about 25% of the population. Some areas of the economy, particularly manufacturing, construction, wholesale, are very, very strong, and anything to do with technology, really big shortages of labour and big increases in wages, but not everywhere. And so if you look in hospitality, which is roughly 1/3 of the economy, they're basically not increasing the hourly rate. They might be giving you more shifts, but they're not giving you a pay rise, if I can put it that way. So there are issues out there that I think are important. The other issue for the consumer is how do they respond to increases in rates? So where the Reserve Bank is at present is they're saying, right, well, we don't need 0.1 for interest rates anymore. We're going to move them back to normal. I think the curve or the market expectations are way too aggressive. We could see interest rates by the end of the year around 1.5%, maybe a touch higher. We see a whole run of increases in rates. So we have rate increases in next week, July, August, and maybe November. You could see another one potentially in September. So you're getting that sort of quick fire increases. Whether they go 50 at some stage will depend on the data. We're still at 25 for next week, but if they did 40, it wouldn't surprise me. I think more importantly is where do you get to? And at 1.5, it does not really cause a big grief for most people on variable home loans. Do remember that the consumer on average for a variable home loan is something like 4 years paid in advance. So they have offset accounts, etc. And you know, you've still got the majority by a long way on variable home loans. Doesn't mean that if you've lost your job and you bought at the peak of the housing cycle, you're not in trouble. You are. But low unemployment helps a lot. On house prices, we're generally saying that this sort of environment would push house prices down around about 10% next year. And in Sydney and Melbourne, they're already starting to go backwards. They're still strong in Brisbane, although they're coming off a bit now, and Adelaide and Perth. So we do expect to see house prices go down, and we do expect to what worries us is not that the consumer is going to fall over. Low levels of unemployment, wage increases help a lot. The banks are not going to fall over, but the consumer might get scared. And that, I think, is important. We looked at a lot of our dynamics of our book. When do people actually have to pay more than what they're currently paying? And it's not a question for this year, let's put it that way. It's a question for next year. And so that's when we think we see things slowing down a bit. So if I look at Australia, my sort of response is I'm pretty optimistic in the short term. I think we will slow as everybody else slows, and we will have increases in rates, but I don't expect to see rates significantly higher than 2.5% by, let's call it 2024. The market is reacting and pricing as if Australian Central Bank is going to basically be more aggressive than the Fed. And I just don't think that's reality. Sure, you need to push it up, but our inflation rates are nowhere near what we're seeing offshore. So you're seeing in Europe, I think the headline was 8%. You got up about 8% in the US as well. And remember, these are central banks that are targeting rates of 2%. So our 2 to 3 target, we're now 3 and a bit or 3.5. So that's a very different world. And there's not many countries out there where wages are growing at 2.5 to 3%. So I do think there's room for the central bank to be a little bit more cautious. Do remember it takes 12 months or so to see what happens in monetary policy. So in some extent, you know, I hear a lot in the press and they say, oh, nothing's happened yet, so let's keep going. Nothing should be happening yet. And so the example that I always talk about is when I used to run the forecasting modelling area of the Australian Treasury, we always think of monetary policy as a piece of elastic with a rock on the end of it. You keep pulling, nothing happens, then eventually keep pull, bang, you get a black eye. So they're the main sort of comments. I think Australian outlook is good in the medium term. We didn't get damaged as much by the virus, and our economy is behaving much stronger than most of the other economies around the world. There are sections that are going to cause us grief, and we're going to watching very carefully in places like particularly construction, if you've got fixed price contracts, et cetera, et cetera. But overall, I think the economy is in a pretty good space. So I might stop there, and Michael, I think you and everybody else is going to join for Q&A.
Well, thanks, Alan, and thanks, Dean, for some fantastic insights. And so what we'll do now is actually kick off the Q&A session to finish this webinar. So can you please just use the Q&A button on the bottom of your screen to ask any of the questions you might have. There's a couple of questions there now, so let me get that going. Alan, the first one is for you, and it's from Michael McCarthy. It's, do you have the same concerns with the Aussie Reserve Bank going too hard on rate rises and not allowing time for the rate rises to take effect and stalling our economy?
I'm going to say trust the RBA more than that. So I would be very concerned if the market pricing actually occurred.
Yep.
I think one of the interesting examples as we look around the world will be what happens in New Zealand, where you've got some really aggressive rate rises already, and you're seeing big falls in confidence and slowing in of activity. And, you know, you could well see a central bank in New Zealand overdoing it. And so I think the Reserve Bank will watch and learn. And certainly I think they've got a good opportunity not to do anything stupid.
Great. Thanks, Alan. That's exactly the way it needs to be, I think. Just another question for Tracy in our markets team. Tracy, in the past year, we've seen the Aussie dollar trade in almost a 10-cent range. This hugely obviously impacts cost of goods and services for businesses that are importing and exporting. How does NAB support these businesses with managing FX exposures and risk that arises from this volatility across our currency?
Thank you, Michael. Certainly a very timely question given the currency ranges over the last couple of months. We saw the Australian dollar hit a high of 76 cents in early April to trade as low as a two-year low at 68.29 in early May. So obviously that has an impact for our customers that deal in overseas markets in terms of their revenues and also their cost of goods sold as well. So our team of specialists here at National Australia Bank, Dashley, are here to support customers and build and execute an FX plan to manage that risk, whether that be the use of forward exchange contracts or other hedging instruments. And I think importantly for the team of FX specialists here at NAB, we are accredited by ASIC to give personal advice to our customers. And we see that as a huge advantage of really being able to assist our clients in how they, in their business, manage that risk, because one structure may not be suited to all customers. So we're here to support the bankers and our clients.
Thanks, Jackie. Now, Tracy, my next question is actually for Jackie, and I was probably reading ahead as I sort of said, thanks, Jackie. So question for Jackie is, how do trading businesses best prepare for continued supply chain pressures? And with that, how can we help with their cash flow?
Yeah, thanks, Michael. So it's really about being able to be agile and adapt. And I think what the last 2 years has shown us is, you know, customers that have been proactive and faced into their own end-to-end supply challenges, they've been able to best navigate through that. So whether it be, you know, engaging suppliers and moving away from the reliance on a single supplier and being able to mitigate that risk, and also adapting to just-in-time inventory. So we heard Alan and Dean both speak about that. And, you know, moving to just in case, we do require obviously a lot more capital to be able to do that, not to mention the warehouse to be able to secure that stock. And then I think also managing customer expectations has been a big one, and not just around timing where we've seen the supply chain blow out, but also around price. In this inflationary environment, if you can't pass on those costs to your customer, it's really going to impact the bottom line. And I think the big one there is also labour. It's still a huge challenge for businesses, with many striving to be, you know, an employer of choice and fostering a culture that ensures you can retain that talent. So crucial in the current labour market. And finally, I will just say, being able to partner with people that truly understand your business. And I implore everyone on the call, reach out to your banker, reach out to your trade and working capital specialist in your local area. We're on the ground talking to customers every single day. As Michael said, I'm in the chilly southern New South Wales. I'm in Wagga today. It hasn't got above 10 degrees, but we're out on ground and definitely able to share insights that we're seeing across the board with our customers to support your business.
Yeah, great. Thanks, Jackie. And I think a great reflection of just the working capital demand in terms of that just in case component is the increase that we've certainly seen across the lending for working capital of about 6.6 billion in the last 12 months. So it's certainly happening and it's real. Alan, a question for you. We always know that economists are great clairvoyants. And so this one is really about where do you sort of see the US and Aussie dollar going over the next 6 months?
Okay, I wish I knew is the short answer.
Exactly. Not documented.
Yeah. We run models, and the models basically say based on commodity prices and rates, the currency should be 78. And, it's 71, 72 sort of thing. And what we worry is that the Fed is going to be very aggressive. So they're going to do 100 basis points in the next 2 months. And also people get worried about the global economy. And whenever that happens, for whatever reason, they all go home to the US Treasury. And to buy a US Treasury, you need to use US dollars. So we've got a formal forecast of 72, i.e. not much improvement from where we are now in the next, to the end of the year. And then we sort of say, eventually gravity works and the models take us back up to about 77. Is sort of the short answer, but not that long ago, about 2 to 3 months ago, we were still with 77 by the end of this year, but that just doesn't look like it's going to happen now.
Great, thanks, Alan. And Dean, a question for you now. If you sort of think about some of the surveys and the stats that you shared with us and the insights around employment and labour shortages, the question is, have you got a guide on what the timeline might be when labour shortages might start to improve?
Tricky one, but it certainly won't be this year in any dramatic way. We know that the previous government, for example, chose not to increase the migration numbers for this year. They did preference skilled migrants over that. But I think anyone who's trying to go on a holiday overseas at the moment knows the challenges of getting a passport quickly. There's a backlog and there's some difficulties in that system in terms of processing. More particularly, I think the foreign student numbers certainly are starting to come back, but we also know that some other countries, particularly the US and UK, got a bit of a head start on us and marketed pretty aggressively to capture some of our market. But the big barrier still there is that transition to permanent residency. We know that many of the foreign students that were helping us in terms of meeting, and backpackers particularly too, in meeting certain job areas, particularly for agribusiness, were looking for that permanent residency going forward, and that still has to be looked at. But at the moment, it's difficult to see, particularly while we're constantly asking about this great resignation question. Those numbers aren't dropping. So it's difficult to envisage how this year we could see much relief.
Great, thanks, Dean. Just a little antidote was I was talking to a hospitality client of ours the other day that said if there's anything that's come out of higher petrol prices is that his staff are asking for more hours, so he can actually get more hours out of his existing casual labour. So out of a bit of positive, there's always out of some negative that comes a positive. Alan, another question for you in relation to, you mentioned the Chinese COVID vaccine isn't very effective against Omicron, and that's why we've sort of seen the continued lockdowns in both Beijing and Shanghai. Has this been acknowledged formally, or is it just speculation as China has always tried to maintain a COVID zero policy?
Well, what we know from the tests is it doesn't work against Omicron. And therefore, if they don't close down, Omicron spreads all over the place. So there's sort of a problem about Chinese face, because the Chinese the government has said, no, it works. Don't worry about it. But we're going to close everything because we've got a zero tolerance for it. So that makes it really difficult, because you don't know it's not going to disappear anytime soon, I suppose, is the bottom line. Because the government's never going to admit that their vaccine doesn't work that well. And, you know, there's lots of medical advice and all that sort of thing there. But you know, it's an issue, and I think it's not just speculation, it's real.
Exactly. And the knock-on impacts are enormous around the supply chain issue. If you sort of think about 30% less. Yeah, exactly. Exactly. No, very much so. Thanks, Alan. Tracy, a question for you. Obviously, we've spoken, and Alan and Dean have sort of talked about you know, this raising interest rate environment. You know, we know that we're certainly in that environment at the moment. What are the conversations that your teams in the markets area are having with some of the customers?
Yeah, certainly, Michael. Yeah, very important. Like the currency specialists are on the ground talking to clients on how to manage that interest rate risk as we move into a higher rate environment. It's certainly challenging, as Alan mentioned, given the shape of the curve at the moment. The market is very aggressive in its tightening cycle. It comes down to, again, the risk that the clients want to have on their balance sheet. If they can afford a higher sort of price through, you know, a lot of clients are choosing to sort of have a 50-50 split around a portfolio approach to their risk management. So different customers have different strategies. Again, very much the specialists work with the customer and looking at what their cash flow cycle is and how we can support them in managing that risk.
Thanks, Tracy. Alan, just one last question, given we're just about out of time. Given the expectation that the slowing economy being more noticeable in 2023, what is the forecast for gross house prices percentage change between now and December 23? Have we got a view on that?
Yeah, we're basically down 10%. So a lot of people say, oh, that's awful, but you do need to put it into the context that they've just gone up 22% over the last year and a half. So we see this as an adjustment that's not likely to get out of hand. If they kept increasing rates much more aggressively, that would be a different issue. But, you know, at this stage, the consumer balance sheet, if I can put it that way, is still pretty good.
Yeah.
You know, as I said, variable there basically paid 4 years in advance. In fixed loans, on what we can see on our book anyway, and I assume we're the same as most, we don't really have a big hit in terms of people going off fixed until next year.
Yeah, no, exactly. Yeah. And the other thing is just the you know, sensitivity testing that gets done for every mortgage is done at interest rates twice as large as that they are today. And
you have a 3% buffer.
Exactly. Yeah, no, very much so. Well, thanks. You know, unfortunately, that's all we've got time for today. And I hope that everyone that's actually joined us for this webinar has really got something from it and enjoyed it. It was all about just trying to provide some deep insights as to what's going on in this sector and specifically around supply chain and the economic conditions that we're facing into here domestically and also internationally. So, you know, from my perspective, I think that we're really fortunate to have such experienced and industry professionals as such as the speakers today and the panelists. So if you could just you know, join me in saying thanks to the presenters that shared those insights, and also more importantly from my perspective, thank you to everyone that's actually joined us today and dialed in. You know, we're really quite happy and pleased that we can actually share what we see and what we know, and it's all about these insights. And ultimately, the key here is that we're really glad that all of you that have joined us choose NAB as one of your partners in terms of provision of financial services. At the close of today's session, you'll receive a pop-up survey requesting some of your feedback. We'd really appreciate if you just took a couple of minutes to provide us that feedback, so that way we could continue to enhance these sessions and also get your feedback as to what you might want to see next. So with that, I just want to say thank you, and thank you again for choosing NAB. Talk to you soon. Cheers. Bye-bye.